Okay, hi guys, welcome to today's session. So for today, we are covering the beginner series for introduction to charts. Right, so I'll just wait for about 1 to 2 more minutes for more people to stream in and we will get the session started. Right, so for those of you guys who are here with us, a very warm welcome. So if you guys can hear me clearly and you can see my screen, right, you should be seeing the PowerPoint slides. Please do indicate under the chat box. Okay, so for today, for those of you guys who are not familiar with candlestick patterns or even on how to read charts, this is where we will be going through today's session. And also just to make sure that you guys are fully equipped with what you need to start technical analysis. Okay, let me just turn on the camera as well. Okay, so let's get the session started. Okay, just a quick introduction of myself, right? I'm Lee Sing. So I provide FX advisory to institutional clients. I'm also part of the team that's recognized by the Technical Analyst Awards as finalist for the best FX research. You can reach out to me on LinkedIn as well. So for those of you guys who are watching a recording of this, right, if you have any questions with regards to the content that are presented on Wednesdays, Thursdays, or Fridays, right, do reach out to me on LinkedIn. If you're here with us right now live, right, feel free to put your questions under the questions chat. So just before we get the session started, right, just understand that the information presented here is for educational purposes only and do not constitute as investment advice. At the same time, I will also have the chat and Q&A box questions on the box open, right? So I have them on the other screen. So if you guys have any questions, right, do put them there and I will check them once in a while. Okay, so this is the agenda that we will be covering for today. This is a 30-minute session, right? So for a start, we will cover on how charts reflect price action. So this is really understanding more on what it's how supply and demand zones interact and also what we can interpret from there. And then following which, we will also look at the basic price points in charting, right? So we'll understand a little bit more on Japanese candlestick patterns. At the same time, we'll also be going through the different data intervals. So after this session, right, you should be familiar with Japanese candlestick patterns, at the same time also looking at the different data intervals. And then finally, right, we will look at how we can determine a range in a candlestick chart, right? So when you're given a few candlestick patterns, seems that the chat is disabled. Okay, so if you guys have any questions, right, I don't think you are able to speak, but at this, if you guys have any questions, do put them under the questions chat. So Rashina, I can see your comments, right? So if you have any questions, just type them there. Okay. So for the rest of you guys, right, if you guys have any questions as well, you can type them under the Q&A box. If the webinar chat is disabled, right, just put them under the Q&A box. Okay, I'll receive both of them. So both of them are open here as well. Okay, so first off, right, we want to cover on how charts will reflect price action. So generally, right, charts are seen as a traditional tool for price keeping. So at the very start of this, right, we do have prices, essentially traders themselves just recording it. So it started off with a point and figure chart, and then slowly it evolved to what we have today, right, which I think the more commonly used ones would be our Japanese candlestick patterns, right? So there'll be the Japanese candlesticks as well as line chart, just to name the more common ones, right? And what's important with this charting is that they can detect trends and also help us to forecast future price activities. So by looking at this, right, when you open up any charts, you can see whether prices are moving higher or lower, right? So in general, this can be broken down into 3 parts in terms of future price activities and trends. Okay, so in trends itself, you can see that we have 2 types of movement. Essentially, one would be a strong uptrend where you can see clear higher highs and higher lows being formed. The other one would be a downtrend, right? So essentially, you see clear lower lows and lower highs being formed. So if you take a look at any chart, right? So these are the 2 trends that we have. And then the last one that we have is essentially prices moving sideways. So you can see that this is an area where price support both it respects both support and resistance levels, and you don't see a clear movement in terms of where prices are heading to. So it's essentially going sideways, you can see here, right? So these are the three types of trends that we can look at. So in general, when we open up any charts, right, again, a big part of it would be dependent on your trading strategy. So if you are doing more trend following trading strategy, essentially trading or looking at indicators like your moving average, right? So if you're trading within the trend, then what we want to look out for first is to identify trending markets. So for trending markets in general, we want to see clear higher highs and higher lows being formed, or lower lows and lower highs. So either in a bullish trend or a bearish trend. Right, so after this, right, we can also look at the assumption to forecast the future price activities. So what we mean by this is that in a bullish trend, in an uptrend, right, the idea is that the trend will continue. So that the basic assumption is that the trend will continue until there is a reversal on the smaller time frame. So in an uptrend, we are expecting prices to form higher lows and higher highs. And what this also means is that when we do see a pullback over here, right, so let's say if prices are forming your higher lows and higher highs, looking at this example that we have on the screen, on that pullback itself, right, when price comes into a support area that we have over here, we want to go down to the smaller time frame, right? And what this tells us is that if on the smaller time frame, there is a change in market structure, we could see that price could continue on the upside, and then again, forming the zigzag pattern that we have here. So this is the basic assumption, right, that the trend on the higher time frame will continue unless there is a reversal, right, or there's a change in market structure. So if you're not very familiar with what I'm saying, right, not to worry. As we go deeper into this session and in the future sessions as well, right, you can see how this all plays out in the analysis and also in this the theory part of it. Okay, so this would be on looking at trends and how we can forecast activities. So in general, when you look at candlestick patterns or just charts in general, right, in technical analysis, you can see very clear price changes as well in an uptrend or a downtrend. You can also see the trends and patterns. So with regards to trends and patterns, excuse me. So with regards to trends and patterns, you can see that patterns in general, we are referring more to chart patterns. So continuation and reversal patterns. So in this case, right, some patterns that we have, the common ones in technical analysis would be your head and shoulder pattern, right? So in an uptrend, what head and shoulder signal is a reversal, right? It's a pending reversal. So the head and shoulder pattern itself, it's confirmed on the break of the neckline. Okay, so this is an example of a trend. So again, we won't go too deep into it, right? So for today, it's more of an introduction and understanding continuation, reversal patterns, but more importantly, understanding how charts can help us to determine the direction, right? And also how we can incorporate it in our analysis. And then next, we also look at the interaction of supply and demand zones. So in this case, right, it's the same concept as support and resistance level. The idea is that when price comes into this area and interacts with a specific zone, so assuming that price came into this region, interact with a specific area, you can see that once price fails this zone, what it creates is that this area then becomes a resistance turn support level. We're expecting price to test this region and then again continue on the upside. Okay, so for this example itself, later on, we'll look at how we can actually combine supply and demand zones, right? Essentially look at their interaction and try and see how we can actually determine price action from there. So for this example, I'll actually take a look at euro-dollar chart in a while, right? So what charts can also tell us is that there are different market forces at play. So what this suggests is that you can see that in a bullish market, let me just clear all the drawings, right, so that it's clearer. So in a bullish market, what happens is that you can see prices are forming your higher lows and higher highs. So in general, in a bullish market, your buyers are in control, right? And then all these highs that we have, or all these resistance levels that we have over here are constantly being run. Okay, and then we look at support and resistance level as well. So this ties in very closely with the concept of supply and demand zones. So support and resistance levels, right? So for those of you guys who attend our live analysis, you do see that support and resistance levels are incorporated in our live analysis session. So what we do with this is that on the higher time frame, we will look at the support resistance levels, identify these key zones, and we go down to the smaller time frame to try and find our entry. So for the psychology of traders, right, what this shows us over here in terms of support and resistance levels is that when price comes into this area, you saw that rejection off once. Coming back into this level again, you can see that there'll be buyers entering the market to push price higher. So this is one portion of it. Of course, right, this is not all there is to it in technical analysis. what is more important is that instead of just identifying any support resistance levels, we need to look at first the direction or the order flow, right? So essentially looking at the direction of the trend first, because in a downtrend, right, what's important is that we're not expecting the support levels to hold. You can see that in a clear downtrend, what happens is that these support levels are constantly being broken. The resistance levels are the ones that are holding. Okay, so support and resistance level is just one portion of technical analysis, but what's more important is to combine them with order flow, right? Understanding the market structure on the higher time frame and helping us to determine the direction on that. So again, for this example itself, right, I will show the trade on, or rather I'll show the example on euro dollar, right, and how we can potentially enter the trade from there. Okay, let's take a look at the next slide now, right? And if you guys have any questions as well, don't hesitate to put them under the questions chat. Okay, so just back to the basics first, right? So if you open up any candlestick pattern, right, this is probably how you would see it, right? So this they basically represent the same things, but in different colors. So the first one that you have on the left, this is a bearish candlestick pattern. So you can see that both of these are bearish candlestick pattern, but depending on your chart, right, if you want to have it either in green and red, then this would be the one you see on the left. If you want to have it in black and white, then this would be the one that you're seeing on the right. So in this example, you can see that the one that we have on the left, essentially both of them in a bearish candlestick pattern, you have the wicks, right? So the wicks would represent the high and low prices. So you can see in this case, right, the high and the low. Let me just annotate it. So you can see in this case, right, the high and low prices that we have over here, and the body of the candle. So these are the same, right? They're just in different colors, but they are showing the same things. The idea that we're showing this is just to let you guys see that a bearish candlestick pattern, usually they're represented either in red or black. Okay, so what this shows over here, because it's bearish, essentially it shows that there is selling pressure. So your open price, where price started, would be higher than your close price. So what this shows is that in this specific time period, you have sellers essentially coming in and prices are pushing lower, right? So prices are dropping and then it's recorded in a specific time frame in this candlestick. So it's the same thing over here, right? So like we've mentioned, this is the same idea, but just in different colors. So bearish candlestick patterns themselves, they're represented either in red or black. Okay, so these are the common ones. Of course, you can set it to other colors as well. You have your open price being higher than your close price. So the idea is that in this candlestick pattern itself, you see many sellers coming in and it's pushing the price much lower. The shadows itself will indicate the high and low of the session, right? So the high of the session, it's basically represented by the wick, and the low it's represented by the bottom wick. The body itself indicates selling pressure. The reason why this is important is because when we go into the different Japanese candlestick patterns in future sessions, understand that when you have a body of a candle that is extremely long, right, with small wicks, what this shows you is that the open itself and the close prices, so where price started out and where price actually closed, you can see that you have basically strong selling pressure. Okay, whereas one with very small body itself, you can see that the open and close prices are extremely near and long wicks. This itself is called a doji, right? So for doji in general, they represent uncertainty in the market, right? So essentially a point where there's hesitation in the market before price moves on. So these are the two things to take note of in looking at candlestick patterns in general. Understand that in a candlestick pattern where you have very small body, this usually represents uncertainty in the market. In this case itself, the one with a long body in this case, you can see that this usually represents very strong selling or buying pressure. So because this is a bearish candle, right? So the body that we have over here, a bearish body would represent strong selling pressure. Okay, let me move on to the next slide. So the next one that we have is some bullish candlestick patterns. So essentially they are pretty much the same thing, right? So in a bullish candlestick pattern, what we are seeing here, it's usually the colors are represented either, let me just change this, right? So either in green over here, right? So if you have a standard green and red colored candlestick, right? Then in this case, the green candle would be the one that represents the bullish candle. If you have one that is in black and white, then in this example itself, you can see that the white candle itself would be the bullish candle. So it's the same thing, right? So the high would be denoted by the wicks and the lows by the bottom wicks, and the body of the candle itself would represent the buying pressure. Because this is a bullish candlestick pattern, what this shows you is that from the open price itself would actually be lower than the close price. So think of it this way, right? So in a specific period, you have buyers basically coming in, right? And you have buyers basically coming in, buying to push price much higher. And once the session closed, right, it's actually captured in this, represented by this one candlestick here, denoting the open, high, low, and close prices. Okay. Excuse me. Okay, so it's the same thing, right? So essentially, they both represent the same thing. The idea here is just to show that bullish candlestick patterns, they are usually denoted either in green or in white. Okay, let's move on to the next slide. Okay, so the next one we will be covering on would be the basic price points in charts, as well as the different data intervals. So the common data intervals that we see, right, the ones that are commonly used would be the M15, right? So M just means minutes. So when someone say that I'm on the M15 minute, the M30 minute, what this shows is that I'm on the 15 minutes time frame, 30 minutes time frame, right? H1 means 1 hour, H4 it's 4 hours, D means daily, W means weekly. So if you load your trading view chart, right, you can see that you can toggle between the different time frames. So for those of you guys who are new to this, right, what does the different time frames actually mean, right? So what's the difference between highlighting the M15, M30? So essentially what this does is that the M15 minutes time frame would capture the price movement. So imagine if you take a look at it on the 1 minute, right? So let's say you have 15 candles running around and you have price moving around here. And this is 15 candles on the 1 minute time frame. So you have 15 candles, right? You track it for 15 minutes. And essentially on the 15 minutes time frame, all of this price point, all of this data point would transform to one candle, right? It's all captured in one candle. It will take the highest point. So let's say the highest point is this point here. Let me just pick the colors, right? Let's say this is the highest price, right? The pick that we see here. So this would then take the highest price. Let's say the lowest price is this point. It will record the lowest price, right? The price point, and then the open and close price, right? So it will record the open and close price here as well. So all of this data that you see, right? If you take a look at the 15 minutes, right? You record it for 15 minutes, how price react. When you take a look at a 15 minutes time frame, that is how price would, all of that will go into one candle. And this candle itself would denote the open, high, and low close of all this price movement that we see here. Okay, so that's essentially an explanation of what the time frame means, right? So when people say that they're on different time frames, that's essentially what we mean. So if you're on the daily time frame, the weekly time frame, essentially the weekly time frame would represent the price movement. It captures the OHLC values, which represents the open, high, low, and close prices by the wick, right? In that wick itself, it captures the open, high, low, close prices, right? And it forms into a specific candle. Now, what this suggests, right, when we have these different time frames, is that you can see that on the higher time frame itself, the weekly, the daily, right, this would be less choppy as compared to the smaller time frames. So how we can see this is that if you take a look at trading view, right, so if I were to open up trading view, you can see that this is basically trading view. Let me just clear the drawings. Right, so the reason why this is important for us to understand is that, let me just get rid of the annotation. Okay, there we go. So this is euro dollar on the 30 minutes time frame. So again, like what we've mentioned, right? So basically on the chart itself, right, this movement, if you take a look at this movement, just this candle itself, this candle, if you go to the 1 minute time frame, right, it represents the movement and price on a 1 minute. So 1 minute is currently the smallest that I have on trading view, right? So this is why. So you can see that within this candle itself, you can see that there will be 30 candles over here, right? So prices have yet to close yet, so it's still forming. So you can see that on the 30 minutes time frame, this specific candle that I've highlighted over here, right, it actually captures 30 minutes of 30 candles, right, on the smaller time frame. So they will take all this data that we have, right, this whole picture, they'll take this data and they will transform it into one candle. If you're on the 30 minutes time frame, it captures the data and it captures the open, high, low, close prices, and they'll all be fit into this one data. So you can see that on the 30 minutes time frame itself, if I go back to the 30 minutes time frame, you can see that this candle by itself over here, right, on the higher time frame, so the 30 minutes, it will be less, or it'll be clearer, right, as compared to your 1 minute time frame, where you can see a lot more movement and it's a lot more choppy. Okay, so this is the reason why whenever we say that we want to start the analysis from the top-down approach, looking at first the higher time frame, like your weekly, your daily, right? There's a reason for that. It's because it's less choppy on the higher time frame, right? So something that you see over here, maybe strong movements like this on a 1 minute, as we can see in this case, right? You can see this choppy movement. On the 30 minutes time frame, it's just represented by one candle. So when you take a look at a higher time frame, you'll be able to tell the moves more clearly as compared to, let's say, the 3 minutes time frame or the 1 minute time frame, where you can see that there's a lot of choppy movements and more spikes here. Okay, so that's not to say that the 1 minute time frame or the lower time frames are useless. In fact, these smaller time frames are important in helping us to identify our entries. So the reason why I say that is because, right, we look at the fractal nature of markets. So essentially the fractal nature of markets, right, we don't have it here, but the idea is that what you see on the smaller time frame what you see on the higher time frame will be seen on the smaller time frame. So the idea is that if prices are forming, let's say, again, I go back to the example of a clear uptrend, right? So if prices are forming a higher lows and higher highs, you see a clear uptrend on, let's say, the daily time frame. Within the daily time frame itself, right, I'll put it in a different color. But the idea is that within the daily time frame itself, you can see this, let's say this blue line, you can see that there'll be smaller key market structures that are being formed. So this is the daily time frame, but if you take a look at maybe, let's say the blue one would represent the 30 minutes time frame. So the 30 minutes time frame itself, you can see that over here, right? You see the reversal on the smaller time frame first, on the 30 minutes first, before you see it on the daily. Okay, so this is what we call the fractal nature of markets. The idea is that you will see the same pattern repeat itself across different time frames, and you can use the smaller time frames to help us to determine the reversal, right, before looking at the reversal on the higher time frame. Okay, so if this still sounds a bit more confusing, not to worry, right? We'll take a look at the example on euro dollar, where I'll explain clearly what is the meaning or how we can combine the weekly time frame, and then looking at the smaller time frame, the 15 minutes, right? So how this actually integrate together to help us to find potential entries. Okay, so this is on the data intervals, right? And then the next one we talked about, which we covered, which is the OHLC value. OHLC value represents open, high, low, and close prices. Okay, I will not write that out, but essentially O just means open, H means high, L means low, and C means close. So they will record the OHLC values in the candle, and you can see how they play out, right? You are able to use the candlestick patterns to determine the trends as well. And then we have also covered on how higher timeframes hold more weight. So in general, higher timeframes are less choppy, right? You see that on the 30 minutes time frame compared to the 1 minute time frame. I've also mentioned the fractal nature of markets, right? Essentially, the idea is that you can always see the smaller time frame reverse off first, right? So if we see any reversal, it will be taken note of on the smaller time frame first before the higher time frame. So in a clear uptrend, right, the reversal will be seen on the smaller time frame first before it's actually forming the part of a bigger picture. So let's see something like that. Okay, so this is what we've covered over here. We will take a look at this on the euro dollar example. Okay, and then first, the next slide that we want to cover, it's really on looking at the range in a candlestick chart, right? So in general, the range of the candlestick chart, if you recall earlier, right? So this is how it looks like. So let me just draw out the candlestick chart, right? So you notice this, right? This is the open and this is the close price. So if it's a bullish candlestick pattern, you can see that, or bearish candlestick pattern. Let me just color this, right? So in a bearish candlestick pattern, you can see that this represents the high, this represents the low, and the open prices would be lower than the close price. So in looking at the range of the candlestick pattern, right, the range is really basically looking at the highs and lows of this price. So if I were to bring out trading view again, you can see over here. Let me just clear this, right? So again, looking at this trading view that we have. So let me just go take a look at the daily. Okay, I have a question, right, for OHLC. Okay, so OHLC, right, O basically represents open, H represents high, L represents low, and C represents close. So the idea is that within a specific period, so let's just use this example. Let's say on the daily time frame. Right, so on the daily time frame, you can see that because we have not come to the end of the day, this price is still forming, right? But if I were to refer to the previous candle over here, essentially what this shows is that on that day itself, right, what is the open price? Where did price started out? What's the close price? What is the high that's recorded for that day? And what is the low that's recorded for the day? So this would be because it's a bullish candlestick. So price opened lower and it closed higher. And then the wicks itself, you can see the wicks itself here would represent the open price. The high and the low here. Okay, so this is what OHLC represents in it. Okay, so I hope that answers your question. It's clear. If it's not, do type other questions that you have under the chat as well. Okay, so as I was saying, right, so on the daily price itself, you can see this area, right? So essentially this region, right? If you want to take a look at the highs and lows, you can just record this. So this zone, right? I will just put a magnet mode. So what this does is that it captures this point exactly. So you can see that this is the highest point and this is the lowest point. So what this tells me is that within this day itself, right, prices are trading. This is the previous day range that prices are sitting within. You can see that between this whole move, right, between these two lines, this is the range that prices are trading within. So if price breaks above this area, right, and pulls back, it breaks above the previous day's high. What this tells me is that it's in an uptrend, right? Because in an uptrend, we see that the highs are constantly being violated or highs are constantly being broken. Okay, but in terms of just looking at the day's trading range, you can look at the previous day, right, and just look at the high and low, right? Mark out the high and low. This app that I'm using, it's called Trading View. Essentially, you can mark out the high and low, right? Just turn on the magnet mode, hover your mouse across the highest point, the lowest point. That will be the trading range, the previous day's trading range. So you can see that this is basically the trading range on euro dollar yesterday, right? So essentially anywhere between the 1.033 30 level and 1.0443 level. Okay. So yeah, so this is on looking at the trading range. Right, now we also want to look at the interaction between the zone to determine the direction. So for this, I'll hop onto the euro dollar example. Okay, so before I hop onto the euro dollar example, right, let me just run through essentially the idea or the thought process behind how we look at the direction, that's one, right, and also how we combine the different time frames. Okay, so how we look at the direction, it's one of the most important thing, and then also looking at supply demand areas, right? So and the different time frames involved. You can see in this example, we have the weekly time frame, which we looked at. We have the 4 hours time frame, which we will be looking at, and we have the M15 time frame. Okay, so these are the different zones that we will be going through right now, and also how we can use the different time frames. So let me just hop onto the euro dollar chart and show you guys an example of how we can combine all of this together. So if you take a look at the weekly time frame on euro dollar first, right? So again, what the weekly time frame represents. Let me just clear these drawings. Okay, so what the weekly time frame represents, it's that. Okay, so what the weekly, sorry for that, right? So what the weekly time frame represents in this case is that essentially one candle itself, you can see this candle itself, would represent movement within that week. Okay, so the open, high, low, close prices are recorded for the week. So you can see that the previous week, which is essentially this candle that we have, right? Last week's price action is extremely bullish. So you can see that if you're to zoom into this portion of the chart, go on to the 4 hours time frame, you can see essentially what happened here, right? There's this strong upwards movement. So this is one thing to look at, right, for the higher time frame. Another thing to understand is the concept of higher highs and lower lows, right? So you can see over here, right? So if you focus on this portion of the chart, essentially, you can see that coming into this area, right? So this has to do with a little bit of concept on supply demand areas. Okay, so just before we hop onto this example, let me just do a brief run through of what supply and demand zones mean, right? And how we can use them. And then I'll use this example to show you how we can actually use supply and demand zones to help us to determine direction. So in this example itself, you can see that in general, right, the idea is that when price react off a specific region, so let's say if you have a candle here, let me just use this example, right? So let's say here, this candle. Okay, so let's say you have a candle over here, and then what you have over here is that price came into this region. So you have strong price action coming into this area, and essentially price respected this candle. So there's this specific zone where you see price interact with the candle, and then price fill this area. So what this happens is that essentially it's trying to tell you that coming into this region, you have basically buyers that are trying to get into the market, right? Which is why we saw this price reaction. But what we also see following, which is that the price itself, right, the buying pressure failed to push price much higher before it actually failed and continue on the downside. Okay, so this is an example of how you can actually combine supply demand areas. So this itself used to be a demand area because of how we saw price interacted with this region, the reaction, before it failed completely. And once it failed completely, it creates supply zones. So if you take a look at this example, right, it's the same thing. So notice this example on the weekly time frame. You can see this area over here, right? So essentially, we have this as the supply area. You can take the extreme of the candles, right? So essentially, you can mark out the moves first. So taking a look at these moves, you can see clear bearish downtrend with lower lows and lower highs being formed. So this is the last high, right? So if I have to mark it out, you can see very clear zigzag patterns. You can see that this is the last high that we have over here. And on this high itself, you can see that this would then be a supply region. So take a look at how price actually react off the supply region. So if I have to zoom into this portion of the chart, you can see over here, right, essentially what we have is that price tapped into the supply region once. You see that strong spike into the region. We saw that rejection. And then again, when price tapped into the region here, you saw that rejection again. So if you take a look at it on the daily time frame, you can see essentially this is how it looks like. Okay, so this is the supply region on the weekly time frame, which we found earlier, right? So we highlighted this on the weekly time frame, this gray zone. I'll just put this as the weekly so that we can remind ourselves it's from the weekly time frame. And then what you see following which is that price came into this region, right? And it tapped it once, showed that rejection, and it pushed higher. So what this tells you on this area itself is that when price came into the region, it rejected off the area and drove price once again into this resistance or this supply area that we have over here. This is the important part. What this shows you over here is that this area, right? So what's the last candle that drove price in? You see the last candle that drove price deep into this area. It's actually this candle here. You can see this candle. This is the last candle that's still held within this area, right? So essentially, you see price drive into this supply area, push down, and then it drove price back into this supply area again. So on this area itself, you can see that this candle is the last or the extreme candle of this whole push up. You can see this, right? So this is the extreme candle, which is why this creates a demand area. Okay, so you can see how price tapped into the demand area over here. And then it pushed higher. Now, the concept of this, right, it's also combining whole order flow, right? Essentially understanding that if prices continue on a downtrend, right, notice that back then it was in a downtrend market structure, right? So if price were to continue on its downtrend, we should expect, right? So recall at the start of the session, we talk about assumption of trend. In a downtrend, it should continue lower lows and lower highs. But what you're seeing over here is that you can see that price failed to form a new low. It fails to break this previous low. So what this tells you over here is that this high itself, it's not an area that would hold, right? So price failed to form the new low and it pushed higher. And right now you can see that coming into this region itself, right? This area itself, price started respecting demand areas. And this is a demand area itself because we saw how price actually pushed and drove price into this supply. Okay, so this has to do with this interaction of supply and demand and understanding where order flow is. So you can see over here, right? So essentially when price drove, it tapped into the resistance or supply area, and then you see this rejection of this, right? We wouldn't have caught the first move because the assumption is that price should continue your lower lows and lower highs. But the second move up, where you can see price once again drive deep into the supply area, what this tells you is that price then fails to form a new lower low, and then price came in, it respected a demand, right? Because it fails to form a new lower low, it creates a new demand, and price once again come into this area. When price taps into this region, what this tells you is that there is a change in structure, right? So instead of the lower lows and lower highs being formed, right now prices are respecting demand areas, and you can target this high that we have here. Okay, so that's the thought process, and that's the flow, understanding the order flow on the higher time frame. And once you have that direction, right, what you can do, again, go down to the smaller time frame. It can be on a 4 hours time frame. You can see this region itself, right? Again, narrowing down the buy region. So on the 4 hours time frame, you can see that you can narrow it down to this area, essentially the last candle that we have within this zone, which is essentially this area here. So again, you see how price tapped into this area, right? So this is the last candle. You can see within this move itself, this is the last candle, and this is the zone. Okay, so this is on a 4 hours time frame. And then once again, I want to put the pointer over here, and then we can narrow it down to the 15 minutes. So on the 15 minutes, you can see clearer price action. This is also where you can combine support resistance levels. So if you take a look at the section itself, you can see that on the 15 minutes, right? Recall at the very start of the session, I talk about a change in market structure, right? So I say about a fractal nature of markets and understanding that if we were to see any reversal, we need to first take note of it on the smaller time frame. So whenever price reverse, right? If you see this strong push up, you will first see that reversal on the smaller picture first. So if you take a look at the 15 minutes, you can see that coming into this region, right, this gray zone that we have over here, essentially you have lower lows and lower highs, still bearish market structure coming in, right? And then you form a new low over here. And price tested this new low, new high, sorry. It forms again, right? Assumption on a bearish market structure is that if it continues, right, it's supposed to form new lower lows and lower highs. But what you're seeing over here is that there is a change in market structure. How so? Look at the highs and lows being formed. You have a high here, a new high here, and then a high, and it's not forming any new lows anymore. If you take a look at this lows, you can see that this is the last low that we have. Price once again pushed up, tested this high, we saw the rejection, and then what you see over here, it's a very clear break of this high. You can see that this is the last high that we have, and you see this break above this high over here. So this is the first sign that there is a change in market structure. What's even more important is that this is a sign that there is a change away, right? You're seeing this reversal, and the 15 minutes is telling you that there's a change on the smaller time frame, and this is in line with this 4-hour zone that you have found. So this 4-hour support area. So following the break of this, right, this is the one that would capture. So essentially when price taps and breaks above this zone, you can see this horizontal resistance area or supply zone. Once it breaks above this region, what this tells you is that this respects the higher time frames bullish order flow. And we can target, right? Recall the high that we have. The high that we have, it's on the 4 hours. So on the 4 hours time frame, you can see that this is the high, right? So where was I? This high, right? So if you take a look at it on the 4 hours, you can see that this was the high because this was the last high that drove price into this area. Once you see this reversal on the smaller picture, what this tells you is that there is a change in structure, right? And this high fails to form a new low. This high would be the target. Okay, so I hope that that's clear, right? So essentially coming once price breaks above this on the M15, you can see this region. You can see that once price breaks above this high on the M15, which is basically this high that we have over here, this high, right? So this area. So once price breaks above this on the M15, it's bullish, right, on the 4 hours. And you know that the target, it's higher up, which is this area here, the 4 hours, this line that we've drawn on 4 hours, this one. Okay, so you can see how price pushed up very strongly and then it came and tapped into this area. Okay, so I hope that that's clear, right, in terms of using this example to show how we can actually combine the different time frames and also understand market structure, right, using market structure to help us to understand where price could potentially be heading to next. Okay, so like I've run through, right? So I'll run through the steps again as to how we actually look at euro-dollar and determine this structure. So first we look at the highs and lows of the candlestick. In the bullish market structure, it should form higher lows and higher highs. In a bearish market structure, lower lows and lower highs. Once we see a reversal, we will always see it on the smaller time frame first. In that example on euro-dollar, we saw the reversal specifically on the 15 minutes first, right? We saw this on 15 minutes. You see this reversal on the 15 minutes first, and once there is a break in structure on the 15 minutes time frame, it is aligned with the higher time frame, which is the 4 hours order flow. And then we look at the interaction of the zone to determine the direction, right? So this one, we covered it on the weekly time frame, essentially understanding that prices tap into the weekly area. So if you notice this, right, on the weekly time frame itself. Let me go back to the weekly and clear all those drawings. Right, so on the weekly time frame just now, we saw this, right? So essentially, price coming in to tap this weekly resistance area. We saw the tap of it twice over here, right? So we saw how price rejected this area once and then again over here. And when price drove price into this area, it pushed up again and it came into this region. This is when we know that it's bullish once we see this reversal on the smaller picture. Okay, so I hope that this is clear in terms of how we can look at it, right? So we look at the weekly range, we combine the 4 hours demand area as well to identify the direction. And then we look at the smaller timeframes confirmation. The smaller timeframes confirmation really come in the M15, right? So once price breaks above the M15, we also look at identifying support and resistance zones to enter. So this is the last part which I have not covered yet, right? So the idea is that when you take a look at this, so let me go back to the 15 minutes time frame. So having identified all these areas, right? Let me just clear all the drawings so that we are clear. So over here, right? Once we see that break in the M15 minute structure, let me just bring it up, right? This is slightly laggy. Right, let me just remove all of this. Okay, so once we see that break in the M15 minute structure, which is really here, right? You see the break of the high. So once price breaks above it and it's from this area itself. Once price breaks above this region, you can see that price actually came in and revisit this resistance turn support area. So notice this zone, right? So for those of you guys who attend the live analysis session, you can see over here, right? So we went through different types of support resistance level. This is one of the support levels that we've covered, essentially looking at how price interact with this region. You can see that price tested as a resistance. You see buyers coming in, fail to push price lower, pushed up higher, and you can see this push up. So this zone itself, right, is respected as both a support resistance. You can see how price came in, tested it multiple times, and following the break in structure. So this is the confirmation for the buys or the longs. You can see that price once again pull back and tap into this area again, this zone, before it actually continued much higher. Okay, so this is another example of how we can actually combine all these concepts together. Okay, so I hope that this is clear, right? If you guys have any other questions, right, do put them under the chat. So in summary, we did cover on how charts reflect price action, right? So for this, we look at the interaction between demand and supply. Understand that when price interact with a specific area, right, if we see a reaction of this and then a failure after, basically it's a demand area turn supply. Okay, so it's the same concept as support turn resistance level, right? And this can give us a hint to the direction. We look at that on euro dollar, right? The example where price drove into the supply region once, and then we saw that rejection failed to form a new low, and it pushed higher again. We also looked at the basic price points, right? So essentially understanding OHLC values. OHLC just represents open, high, low, and close, right? So we have a question on that just now. So essentially what it does is that it tracks a specific data interval, right? So if I have a 15 minutes time frame, it will basically take the past 15 minutes of price data and put it into one candlestick itself. We also looked at the higher time frame. So in general, higher time frames like the weekly candlesticks, the daily candlesticks itself, they would hold more weight as compared to your smaller time frame, like your 15 minutes. So maybe to elaborate a bit more on that, right? Essentially, a resistance area or a key level that you see on the higher time frame, on your weekly, your daily, they will be more respected as compared to the smaller time frame. Like your 1 minute, you can see that if you have to open a 1 minute chart, any support resistance levels, right, they can be whipsawed around easily. And then finally, we look at how we can determine a range in candlestick patterns, right? So for this, we look at the the high price as well as the low price. So in this example itself, you can just open up any candlestick pattern. If you want to determine the daily range or the previous day's range, right, just open up the candlestick pattern, right, highlight the high and the low of the range. You can see that this will be the high of this range, and this is the low from the previous day. Right now, prices are still forming, right? So you can see that it's still moving over here. Right, so we'll need to wait for the session's close. Okay, so with that, we have come to the end of this session. But I hope that this is clear, and also at the same time, it helps you to understand a little bit more on candlesticks, right? So looking at candlestick patterns, you are clear as to what the different time frames represent and how we can actually combine them across the different time frames to analyze this and potentially determine the direction. Okay, so with that, we have come to the end of this session. We have a 5 o'clock session as well by Yongqing. So just go to vantagemarkets.com, right? Okay, I have a very interesting question. So do you think it's possible to buy and sell exactly? Shall I have to be focused on 15 minutes or 1 hour? Yes, it's possible to buy and sell exactly, right? So for this, you need to combine the order flow, right, across different time frames. And I would say that depending on how narrow you want it to go down to, usually I go down to the smallest would be on the 1 minute. So you can actually use the same idea, right? So apply the same concept. You take a look at it again on the smaller time frame. So let me just give an example on, let's say, gold, right? So you see this reversal on gold. Let me just remove all of this, right? So this area itself, you can see on gold, right? So again, combining the higher time frame first, you can see this is the higher time frame. So this is the daily time frame. You can see this region. So this is the daily. You can see that price came in, tapped into this daily area here, right? And then you want to use the same idea, right? So we have the daily time frame. You go down to the 4 hours time frame, and again look at the market structure. So you can see that price came in, tapped into the daily time frame over here. If you take a look at it on the 15 minutes time frame, you can see that there is a clear change in market structure. So this region itself, right? So before the move down, you can actually anticipate this move. So in this case, you can see what happens here. If you look at market structure, you see higher lows and higher highs being formed. If I were to take a look at the range, you can see that this is the last high that we have, and this is the last low. Right? And price came in, it came near this high over here. So again, if price were to continue, so same assumption, right? So if price were to continue a bullish trend and drive deeper into this gray zone that we have over here, it should continue higher lows and higher highs, right? Because if you take a look at how market structure is like previously, you can see that there are higher lows and higher highs being formed. and then it should continue this, right? And if it doesn't continue this, this is when we know that this resistance area on the higher time frame is respected. Okay, but until it shows on the 15 minutes, right, we cannot just take a shot immediately, because you can see over here, right, this is a pretty wide area. So you can see that the change in structure really comes in here. So this is your high, this is your low. And then you can see that price came into this resistance area. It came near this resistance area over here, right? So once price comes near this resistance area, this is when we want to focus on the chart, right? So this area here. So what this tells me, right, combining order flow. So understand that I'm within this range itself. If price comes into this area and on the smaller time frame, right? So by smaller time frame, I mean that anything less than the 15 minutes. If you go to the 5 minutes, the 10 minutes, or even the 1 minute time frame, if it's starting to show that resistance areas, right, support regions or supply areas are starting to gain control and your demands are constantly failing, what this shows me is that this low itself, right, would be my target. Okay, so maybe I explain it a little bit more on that in the next session, right, using order flow. But the idea is that basically when price comes into this region, you can see that there is a clear structure that's being formed with the highs and lows. So if price were to continue, it should be breaking the high. If it doesn't break the high and you see reversal on the smaller time frame, so this can be on the 1 minute, the 5 minutes, right? But the idea is that you can see basically supply regions are starting to be respected. So you won't catch the first move, but the idea is that when you come into the smaller time frame, again, right, recall I talk about the extreme of these candles. So let me just use the extreme of these candles. You can see basically, right, the extreme of these candles are starting to be respected. In this case, this one not so much, right? Price actually came and fall short of this. But the idea is that you can see over here, right, extreme of these candles are starting to be respected. And what this shows you, right, following this, so if you follow through with this, you can see that these supply regions are starting to be respected. So once you see this, right, what this tells you is that on the smaller time frame, on the higher time frame, which is the 15 minutes, recall on the 15 minutes, right, we have this low. So what this shows you is that this low itself, it's now the target. And this low, it's a target because of what we are seeing here. What we're seeing on the smaller picture, which is your 5 minutes, right? So recall back on the 5 minutes, we saw how the supply areas or the supply zones are starting to be respected here. And this is important because we're not just taking any supply areas on the smaller time frame. This supply areas or this hypothesis that we have actually comes because price is sitting on the daily resistance. You see this daily supply area, this gray zone that we've highlighted earlier on, right? So this is the daily supply region. And then once you have a clear structure that's being formed, the high and low, so it's using the concept of looking at our daily range, or not daily range, but marking out ranges, right? You can see that once there is clear structure being formed, you have essentially this last high, which fails to break the previous high. So it shows you that that could be a change in an uptrend, that's one. And then you can see on the smaller time frame, on the 5 minutes, essentially supply zone starting to be respected, and you can see that this then becomes a target. Okay, so this is how you can determine on the smaller time frame. So you ask me about how we can actually determine whether it's possible to sell or buy exactly, right? You can use the smaller time frame, the extreme of these candles, to determine buy and sell levels, right? Of course, this in this case, right, there's also a case that you can be whipped out of the market, but we will leave that for another session, right? So essentially looking at how we can determine exact entries and take profits. We do have a price action masterclass at the end of every month, right? So for that, we'll review the setups. We'll also show specific entries and how we got them. So in this case, you can see that this is how, when you look at it on the smaller picture, how you can actually combine the different time frames and help you to determine the direction. Okay, so I hope that answers your question, James. Okay, I think we have come to the end of this session, right? We don't have any other questions as well. We have another session for 5 o'clock, I believe, right, on Vantage Markets. So just go to vantagemarkets.com. Okay, so I believe we have another 5 p.m. session. So I will leave, I'll leave some time for the next speaker, right? So you can take a look at the schedule here. So these are the different schedules, right? So we have a 5 p.m. session later. And for tomorrow, we will be doing a live trading session as well. So we'll be doing a review of what we did on Wednesday, right? The setups on Wednesday and how that played out. Okay, so with that, I think we have come to the end of the session. We have no other questions as well. So if you guys have any other questions, right, regarding Vantage, or even, you know, how you set up your account, or how do you subscribe to the sessions and all that, right, you can actually email to vantage@markets.com. If you do want to sign up for the webinar session, right, just go to vantagemarkets.com/webinars. You will be able to check the schedule as well as the speakers there. Okay, so I hope that Okay, so I hope that you guys had learned a lot for today, right? How can I be on the next ones? So for tomorrow, we will be doing a live session as well. So for tomorrow, just you can just apply them. I believe you can just apply them here. So for tomorrow's session, just click under the session that you want to apply for, register now. Just go under register now, right? You should be able to see the sessions. Okay, so at the end of this week, I believe next week we do have one, right? So if you're interested in how you can actually find specific entries, how you can also combine order flow across the different timeframes, right? You can take a look at the end. Yeah, so we have this on 25th November as well. So for this, we'll be going through specific trade setups. We'll also be going through basically how we can combine the different timeframes and use specific entries on them. Okay, so this one has to be, it'll be dealing more with smart money concept. Okay, so yeah, with that, we've come to the end of the session, right? You're very welcome, James. Okay, so I look forward to seeing you on the next session as well. So yeah, thanks everyone, right? Stay safe, trade safe, take care. We'll catch you guys again next in the next session, right? We have another 5 p.m. session, so do attend for that as well. Right, so thanks everyone, take care, and we'll see you again soon.